Hi, I'm Ross Mayfield, Investment Strategy Analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Technical Strategy, Chris Verrone, to talk all things markets. Chris, how are you doing today?
I'm doing great, Ross. Thanks for having me. Great to be here.
Yeah, it's absolutely great to have you here. And we're talking to you at a time when the market is experiencing another little rally. It's not the first one across this bear market, but the number one question we're getting is where is the bear market low? And so I'm wondering, from your work on the market's internals, from your work on the macro side of things, are they confirming that this might be something more than just another bear market rally? I know it's an impossible question, but what are you seeing and where do you think we are in this bear market process?
Well, Ross, it's a great question, and I think it speaks to the idea that one of the most difficult things in this business is attempting to differentiate between just a bounce in a bear market or actually the repair process and the start of the next durable advance. And we try to answer that question really looking at three different pillars. What does the composition of the rally look like under the surface? Meaning, is participation expanding? Is breadth getting better? I think secondly, we would want to look at what does the leadership of the market look like? Is it turning over, right? New durable advances tend to bring new leadership with it. And then third, are the macro inputs really confirming the strength in equities? And I think there's been some modest improvements in all three, but I would say it's probably early to call the all clear yet. When we look at the internal composition of the advance, breadth has certainly been a little bit better over the last several days, and we welcome that. On Tuesday, for example, something like 92% of issues were actually up on the day. It was the best single day breadth or participation we've seen at any point over the last 6 months or so. So we welcome that. I want to see more of that. I want some follow through from that. What we've seen historically is when those, quote, 90% up days start to cluster, it can be a pretty good signal. In terms of the leadership front, this is where we're a little bit more suspect. Coming off a low or starting a new bull market, groups like consumer discretionary tend to be very, very dominant. Discretionary has improved here a little bit, but I wouldn't say it's showing over the last couple of weeks has been dominant. And then lastly, on the macro front, this is where I think the most work still needs to be done. When we look at just a handful of macro indicators, if anything, they've actually deteriorated over the last several weeks. We see it particularly with the shape of the yield curve. A month ago, the 2-10 yield curve was 20 basis points positive. Today, it's 20 basis points negative. So I think there's work to do on all of these indicators. I think the good news is we have started to make a little bit of progress here.
That's great context. And I think it just confirms what you all have been saying for a while, which is even if there's improvement, there's a lot of work to be done to repair the damage done to this market. But you did focus on the macro and kind of the challenges there. I think this is a very macro-driven environment. It's inflation, it's interest rates, it's geopolitics. So I'm curious if, as we move forward, if there is one item or one macro indicator that you're watching especially closely to kind of indicate whether things are improving or deteriorating from here.
Yeah, I think it's a great question, and I would again point back to the curve. I think a steepening of the yield curve, particularly a bear steepening of the yield curve, meaning yield curve steepens because the long end sells off, that would give us some confidence that the market's ready to look past or look through some of the economic weakness that may be out there. I think that's important. And then second, I would go back to let's listen to the leadership fabric of this market or the leadership tone of this market. When you're coming off a major low, banks and discretionary and semiconductors, that should really be your early cycle leadership. So I think we'll get some clues there. Remember, when you look historically at what bear market rallies tend to look like, the average bear market rally is something like 15% over about 2 months. So right now, S&P's up about 10 off the lows over the last several weeks. So just to putting that in a little bit of context, I think gives us some reference points of where we may be in this process.
That's perfect, and it gives us something to keep an eye on as we move forward, which is always very useful. So kind of zooming out a bit, just thinking about positioning in this kind of challenging environment. What sectors are you all liking? What industries are you watching closely that look like leadership? And then zooming out even further from that, I wonder if you had an opinion on U.S. versus international. I think there's a lot of angst out there right now about investing internationally with geopolitical risk and COVID-19 risk. So do you all have an opinion there? How are you thinking about that particular issue?
So let me make just a couple observations here. We'll talk about a couple sectors and some groups and then kind of touch on the international backdrop. As far as the sector work goes, the areas that I think continue to demonstrate leadership is where we want to tilt portfolios. For us, that remains healthcare, particularly pharmaceuticals. I do think we have seen a sufficient washout in energy here as well. And you see that, in terms of positioning, you see it in the flow data. The outflows from the energy sector over the last 4, 5, 6 weeks are about as dramatic as anything we've seen over the last year or two. That tends to be a pretty good contrarian indicator. So I do like adding to energy lower here. The defense contractors within industrial have generally remained leadership here. So it is, I think, still a more later cycle, defensively oriented portfolio tilt. I think it's early to say the early cycle or pro-cyclical groups are really starting to bottom here. We'll certainly watch those. Industrials broadly, or industrials in aggregate, are probably one sector I would start to do a little bit more work on. We have seen some hints of improvement in some of the more cyclical components of the industrial sector. Now that tends to be very dollar sensitive, so perhaps a message that the dollar ultimately will weaken here. Now, as far as the international picture goes, I think the way you described it is appropriate. There is angst out there, and perhaps for good reason. We do think Europe is in recession or likely headed there, so it's hard for me to really justify any big overweight in, say, European equities at this point. One area where we have started to see some improvement is with the Japanese stocks, and certainly a weaker currency contributes to that, but Japan, relative to some other parts of the world, has actually started to positively inflect here, so we'll continue to watch that. We largely remain skeptical of China. The credit deterioration there is ongoing, and certainly is something I think investors should be mindful of when they're thinking about their geographic exposures here.
Yeah, so if I could sum up everything you just said in one word, it's selective, right? Be selective with the sectors and the industries, be selective when investing internationally. And that's a very useful tip in this kind of environment. So Chris, this has been tremendous. I want to thank you so much for your time, and hopefully we'll get to chat again soon.
Thanks, Ross.